reporting that they're only about at 33% of Russian gas as versus 40% yesterday. It's been very fast and very quick, and I think that that's part of the reason why you're seeing prices react so quickly, despite the fact that we have this agreement.
Yeah, absolutely. Let's stick with this theme and get another perspective on it. The IMF cut its global growth outlook for this year and for next. It warned that the world economy may soon be on the cusp of an outright recession. Joining us now for more on the report is Pierre-Olivier Gourin-Chasse, IMF Chief Economist. Pierre-Olivier, thank you so much, and thank you for being patient as we tried to get your line to us good. Let me ask you about the European economy, because we've just seen this headline saying that we've seen a new level on European gas prices, or at least back up to levels we haven't seen since early March. This is alarming for those following the European gas story. What is the downside risk for the European economy for you?
Oh, hello, good morning. And yes, it's a very significant downside risk. I mean, in our baseline projections we just released today, we forecast that growth in the euro area is going to slow down to 1.2% next year in 2023. But we highlight that in case there would be a full shutdown of Russian gas flows to Europe, the downgrade could be much more severe by another 0.8 to about 2 percentage point downgrade in terms of the economic activity for the area.
What do you think would actually, what are the chances of that actually being even lower? If you've had to revise it down, the forecast twice in the last few months, what's your worst base case and how quickly could we get there?
Well, this is why this time we have released both our baseline scenario and what we call an alternative scenario that highlights a number of plausible downside risks. And one of these plausible downside risks is this scenario of a full shutdown of Russian gas flows to Europe. So we view this as quite likely, but of course not as likely as the baseline still. There's still hope that somehow gas could still be flowing to the euro area.
Are there parts of the Eurozone, Pierre-Olivier, that now you do assume will be in recession? Of course, we focus a lot, our thinking here, on Germany. And can European countries, the EU 27 working together, can they prevent the worst case scenarios from developing here?
Yes, in some separate set of simulations that the fund has been running, we actually look at what happens if we have effective sharing of gas resources, and it can mitigate and absorb, of course, some of the impact, as well as securing some alternative supplies, LNG supplies from other countries. So all of these mitigating policies will have an impact and will help the European economies.
How close is the U.S. going to come to a recession?
Well, in our baseline, we're not seeing a recession in the U.S. either in 2022 or 2023. We are seeing a significant slowdown from 2.3% in 2022 to 1% in 2023. So this is a quite significant slowdown. And just to give you an idea on, if we look at Q4 to Q4, in 2023, growth slows down to 0.6%. So this is a very low number. And what we're seeing is a very narrow path for the U.S. economy to avoid a recession at this stage. A small shock, a small downside risk could be enough to knock it off.
Okay, so that's where we are on the United States. What about the definition of recession, if I could take you there, Pierre-Olivier? Because it seems that as we sit on the precipice of perhaps seeing a technical recession in the US, that will then provoke a lot of conversations about whether it's possible to call it that when unemployment is as low as it is and the labour market as healthy as it is. How do you tie in the labour market and weak growth?
Yes, I mean, the U.S. is in a situation where the labor market right now is very tight. We have unemployment rates that are at levels that we had before the pandemic, 3.6%, very robust, hiring, lots of job vacancies. So certainly the labor market is very vibrant right now. But we anticipate that as some of the factors that we've highlighted in our update are coming to play out, the fact that inflation is eroding purchasing power, there is more uncertainty, consumer confidence is coming down, and central banks are also tightening monetary policy, then the labor market is also going to evolve and soften, and we may even see an increase in the unemployment rate sometime in 2023.
Pierre-Olivier, I wanted to understand sort of what's the base case for the Fed in your base outlook?
Well, what we are recommending at this point is we're saying, look, inflation at the levels at which we're seeing them in the US or the European economies and other parts of the world as well is just something that generates a lot of instability, macroeconomic instability. It's eroding purchasing power, it's creating uncertainty, it's really not conducive to solid economic growth going forward. So it's very important that central banks bring back price stability, and this is what the Fed and other central banks around the world are doing. And our recommendation here is that they need to stay the course until inflation is tamed and brought back to closer to the central bank targets.
So the focus on inflation is the right fight to be having right now, Pierre-Olivier.
In our opinion, it is. It will have an impact on economic activity right now, but it will secure better foundations for growth and macroeconomic stability down the road. One has to remember that the era that we had over the last 40 years of low inflation, price stability, has been really an important ingredient to macroeconomic conditions. And we need to make sure that we don't enter into an era of high inflation.
Yeah.
It's really very critical.
Before we let you go, you also had a ton of risks in your outlook. And I didn't feel good after reading your report because of it. What's the one risk that people aren't talking about that we need to be talking about?
Well, we highlight, as you point out, we highlight a number of risks. I mean, I think one of the ones that worries us, I mean, it's not that people are not talking about it, but so far it's been holding up pretty well, is the impact of financial tightening on emerging market and developing economies. There's been a significant amount of tightening already. We've seen capital flowing out. We've seen currency, the dollar, appreciating against most other currencies. We've seen spreads increasing in many countries. But so far, it's been quite orderly. And I think that this has certainly been good news, but we are concerned that we could see some more dislocation in global financial markets on the back of this strong monetary tightening that we're seeing in a number of advanced economies. So we have to be vigilant on this.
Pierre-Olivier, thank you so much. We do appreciate it. Pierre-Olivier Gourinchas, the IMF's chief economist, joining us here on Bloomberg Markets to talk about their latest forecasts. Coming up on the European close, let's take you to some data which really illustrates some of the threats that we've just been talking about, certainly with regards to the European economy. The Xetra DAX down by 0.7% today. A lot of pressure on the German economy as a result of concerns about recession and as a result of the thing you see in the next column there. That is the natural gas price here in Europe, in particular the Eurozone benchmark. That is up by 12.7% just in today's session, following a big rise in yesterday's session as well. All of that weighing heavily on the euro as well. We're down back at 101 right now, down 0.8% on the euro against the dollar as we head, of course, towards that Fed meeting. Coming up on the European close, Paul Markham joins us, head of global equities at Newton Investment Management Group. What's his expectation around the UK markets? We've seen outperformance on the UK market today, given what we've seen in oil prices. That means energy stocks are doing better and basic resources stocks are doing better. German markets then, Alex, underperforming, of course, because of all of the questions we've just been talking about around gas.
Yeah, and the playbook here in the U.S., Anna, is really about buying bonds, buying FX currencies that are the safety, and selling stocks. That's kind of the playbook, despite some idiosyncratic factors for particular earnings names. The Nasdaq 100 is now off by about 1.5%. This is ahead of some big tech names coming out after the bell, like Microsoft as well as Google, despite the fact that the last few days has seen some kind of stabilization within big tech. Also, the outperformance of the dollar, the Swissy, as well as the yen, that safe haven currency of choice, really coming into the market. And the best performing stocks within the S&P are GE and GM. So that is, and 3M, I should say, General Electric and 3M. So if you do well on earnings, you do get rewarded. Is all that bad news then wind up being baked in? And is this going to be the kitchen sink quarter? Get it all out, even if it's bad, and then be able to regroup and move higher from here. The worst performing stock in the S&P, can you guess it? That's going to be Walmart. We'll take you through all the details coming up in the next hour as well. This is Bloomberg.
About that all day yesterday.
It's Tuesday, the 26th of July. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Welcome back to Bloomberg Markets, the European Close. Guy Johnson is off today. I'm Anna Edwards, live in London with Alex Steele over in New York. Let's check in on these markets then. And the Stoxx 600 is making very modest gains, but a lot of that has to do with what's going on in London, certainly not what's going on in Germany. The German market under pressure, down by 0.5%. Natural gas prices is part of the reason for it. We talked about this just before the break, but we've seen, of course, the Kremlin, our reporting suggesting at least the Kremlin is going to keep up the pressure on Europe around natural gas through the winter, which was perhaps the basic assumption of many people operating in this market, but certainly we've seen prices go higher as a result of that and other news flow. The euro then also under pressure as a result of the same story, down by 0.8%. So that's the picture across the German market. The London market being held up well, Alex, by the fact that we've got the energy markets doing pretty well, and that lifts oil majors, oil and gas majors, of course, listed here in London.
Yeah, the cash flow they're going to throw up is going to be tremendous this quarter. Here in the U.S., you have the S&P trading a little heavy, down 0.6%. So the downside, we know, definitely Walmart, and then all the other companies that are dragging with it to the downside. You got Ross Stores, Dollar Tree, PayPal, Carnival, Caesars. So anything that's going to be really exposed to the consumer and those inflationary pressures really taking a hit. On the upside in the S&P, though, it's GM and GE. GM cutting its profit and sales outlook, but we had this healthcare spinoff, and then you also wound up having GE, and it beat, had nice positive free cash flow. If you beat and surprise the market, you do get rewarded. So that really puts the pressure on that big tech. NASDAQ 100 down by 1.3%. We get Microsoft, we get Google after the bell today. I did want to point out, though, what's happening in the FX market. It's Euro Swissy is down by a full 1 percentage point, right? A record low for the currency swap. And it just shows the safe haven bid coming into the Swissy, coming into the yen, and coming into the dollar, and coming into the bond market as we look for protection as the earnings picture clouds up, Anna.
Yeah, absolutely. So it isn't just strong dollar, it is weakness in the euro, and you see it there demonstrated against the Swiss franc. Alex, let's get to one of the big corporate stories of the day here in Europe. UBS reported weaker than expected profit in the second quarter. The Swiss bank's wealthy clients stayed on the sidelines due to the global market slump, and now there's uncertainty about inflation and recession. UBS CEO Ralph Hamers talked with Bloomberg Daybreak Europe co-anchor Manus Cranney a little bit earlier on.
What bothers all of us is that it's so unclear as to what is happening. So the next 2 months will continue a bit of unclarity here. I think the central banks are not very clear either. They're very hawkish, so they're really looking at the inflation numbers and reacting to those. In our view, our base case does not expect a significant downturn in the US, but for Europe, for example, we also don't expect a significant downturn unless the gas supplies really get cut off. Now we do.
Is that your number one concern? I mean, today, Nord Stream again, the flow is down. Is that your top concern for Europe?
So the top concern for Europe is indeed cutting off completely from the gas supplies for a couple of reasons. First, it will increase gas prices. Secondly, it will render a couple of industries as very inefficient, right? So they can't work at peak capacity, also increasing prices. And with that, generating further inflation, making inflation stubborn, which is the real danger, right? That inflation is here to stay. And so that's the real risk.
Is that inflation coming through with requests for pay rises?
In some cases, we have seen those already, right? And not only because of inflation, also because in some businesses there is still quite some tension in the labor markets. So that has not gone completely away yet. So it's a mix of inflation and the labor market circumstances. But if inflation continues to be here, of course, it will be reflected also in pay.
You talk about the hawkish mode of the central banks. Rates regime is shifting from the ECB. Next up is SNB. When we caught up, you said, Manus, it's $1 billion. That's what this rate regime change will be. Do you materially uplift that number from whence we last spoke?
No, so the $1 billion that we indicated last time was at the balance sheet that we had at the end of the first quarter, at the then going forward rates. At this moment, we see about 400 million of that already in our P&L, and we still think that scenario holds.
That was UBS CEO Ralph Hammers, and in Bloomberg Daybreak Europe, co-anchor Manus Cranny, who joins us now from Zurich. Manus, I know it's been like a 17-hour day for you, so thank you for staying with us on this. I know his base case isn't recessionary, but does he have to plan for it, and is the bank starting to plan for that?
I think there's a cautionary tone from Hammers, and that is coming through. It's not their base case scenario, but then of course, Noura Rabini's talking about delusional. It's going to be brutal. I think when you look at what happened to this stock today, Alex, down 9%, 5.5 billion Swiss francs wiped off the value of this bank in one day. I sort of almost did a double take when I looked at the screen. I thought, what happened? There's a lack of belief that the performance, it's underperformed on the wealth management, the engine of revenue. The investment bank, underwhelming to say the least, and a $12 billion exodus from the asset management business. But look, everybody liquidated their equities in the first half of the year, unless you were like me, stuck in a pension fund that didn't liquidate. But that brutal deleveraging is more brutal than the muted language that they used in the statement. Advisory fees down 57%. This is the worst day for UBS since the pandemic kicked in March 2020.
Yeah, it is a really big move. And focusing in on one area, Manus, that you just spoke about, the investment banking part of the business, it underwhelmed then. What does that mean for bonuses? Because this has been a really competitive part of the labour market recently.
There's a wonderful phrase that some people sort of say to me when I talk to them about money. No honey, no money. And that's basically coming through from Ralph Hammers on the call, where he didn't say to me, no honey, no money, but he did say on the call, if the deals don't come, then the income is going to be reduced. And that's reflective on the US banks, Alex, isn't it? Nearly $5 billion in comp, variable comp, has been reduced in terms of the US banks. So Hammers reaffirming if the deals don't get done on the advisory side of the business, by the way, advisory was down 57% on the investment bank, and the equities and the fixed income, i.e. the rates business, underwhelmed relative to, let's say, Goldman Sachs, which saw their business rise by 32%. Yeah. So no deals, no flow, no money, no honey.
If you could get him to say that, that would be amazing. And also, Manus, you have a pension?
That'd be a great headline.
105 years old? Who's pensions anymore? Honestly. Manus,
everyone in the wrong. Do you think? Yeah, I think maybe I need to ring the guy that's sorting out the rest of my life. I'll be working forever.
Manus, last question. Credit Suisse comes out tomorrow. What's your read-through from UBS to Credit Suisse?
Okay, well, let's draw a little breath of sobriety here, because this is a whole different ball game at Credit Suisse. This is a bank and a CEO, I would say, in crisis. They're under warning and a watch list by the UK regulator. Will they do massive job cuts, or will they tinker at the edges? Gottstein is the CEO. Thomas Gottstein was put in to steady the ship. He's the last man standing. Everybody else on the board has changed. What are the announcements in terms of really steadying this ship? Credit losses and litigation will be top of my agenda with Thomas Gottstein. And in terms of the rates business, also they are much more Asia focused. So we need a call from Gottstein in terms of the deleveraging and flow of money in Asia. The headwinds for Credit Suisse are brutal.
Okay. A lot to think about then as we go into tomorrow. Manus, thank you so much. Manus Cranny with us there from Zurich with a heads up on what we've already heard from UBS and what to expect from Credit Suisse tomorrow. Manus will be interviewing the Credit Suisse CEO, Thomas Gottstein. That is tomorrow morning, of course. Coming up on this program, traders bracing for the Federal Reserve to raise interest rates again tomorrow. We'll talk about inflation and recession with portfolio manager Paul Markham of Newton Investment Management. This is Bloomberg.
earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projection, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
What we try to do is offer a good, better, best assortment in our portfolio, so people who need a more value offering can find it in the Unilever portfolio. Big brands gained market share versus private label during COVID, and in some categories in some countries, we are seeing a strengthening of private label market shares.
That was the Unilever CEO, Alan Jope, discussing pricing amid the rising cost of living in Europe. So let's get back to our question of the day. Are consumers in a recession? Joining us now is Newton Investment Management Global Equities Portfolio Manager, Paul Markham. And the good thing about this question, Paul, is you can define the terms entirely how you like. But do you see the consumer sector in something of a recession? This question is prompted really by what's been happening stateside with the Walmart numbers and the warning overnight. But that has sent a wave over the Atlantic and actually has been weighing on retail-facing or consumer-facing companies here in Europe today as well. Are we seeing a consumer recession at all?
It does feel that way, Alan, doesn't it? Since we go back a couple of months and look at some of the issues that we had around some of the tech names which faced the consumer very directly, some of the living room stocks, as we've called them, the things that did very well during the recession, we started to see that the further away from the corporates, the closer to the underlying consumer that the companies were, the more likely they were to disappoint. And certainly you could say it's kind of started in the States, and the numbers last night were pretty ugly. But I think the thing to remember is that the US has been more aggressive on rate hikes because it's had more space to play with. But I think actually if you look back over at Europe, at the UK, other parts of the world, they had a consumer which hasn't been as strong in the first place and is also likely to get dragged down in this kind of slowdown, in our opinion.
Paul, Bernstein came out with a note today that said the era of excessive beats is over, and that we could see more downgrades, and that would cause European stocks to fall even more. And something else that you guys have to contend with is, of course, the soaring energy prices from coal, power prices, natural gas, record after record. What is your estimate for how much more stocks can come down based on that?
Well, I mean, certainly on the individual market basis, it varies according to what kind of skew there is from a sector standpoint. But certainly from our point of view, you could see markets come back another, you could go into double digits as regards pullbacks. Whether or not that was, represents an opportunity in the near term is a big question, I think. And the thing which we've been mulling over is whether or not the recession is a technical recession, which is quite shallow, or something which is rather deeper. And from the point of view of the latter, it would certainly be, in our view, no time to be hurrying into more cyclical stocks at this stage. And the consumer is going to have a difficult winter coming up. And clearly that has other implications, political implications, for example. Elections could go different ways, and that could lead to different fiscal regimes. So all sorts of things that could be a worry for markets. And I don't think we're out of the woods or anywhere near being out of the woods just yet.
And when you think about, Paul, the type of recession we might see, whether it might be technical, whether it might be deeper, is the response in the labour market, does that make the difference between the two?
Yeah, it does. I mean, I think what's really interesting is that different central banks have different mandates as regards to whether or not they just have price stability, whether labour's put in there as well. And the theory goes that, two of the three main tenets of managing an economy, growth, labour and inflation, should all two of the three should kind of sort the problem out. And that's not always the case. Things can persist for a period of time. And certainly the labour market being as tight as it has is something which has been very problematic in the near term for some economies. What we may see, of course, is a return to the workforce from some of the older members of that workforce who have retired post-COVID, thinking they, would want to live on their earning, on their savings, and realise that they can't. And that could actually prove to be an area of relief for labour markets going forward. But that will take a period of retraining, decisions to be made by some older people, and the return of that workforce to happen before it can have an impact. So I think, yes, certainly it's been a very, very destabilising time for companies to have these twin jaws of rising costs on one side and lack of availability of labour on the other, and slowing demand, of course.
In the meantime, it's just messy. So that might be the stability in the longer term, but in the medium term and short term, it's messy. And the messiness also is felt in the FX market. I just want to point out a headline for you that you have a hedge fund saying that they're going to see 80, euro dollar go to 80. You're also seeing a record low for euro Swissy. If we get to say 80, what do you do in that environment? What do you invest in? What looks better? What looks terrible?
Well, I mean, the problem that the European economy has always had is that it's not a self-starter, and it is one which has been largely reliant on demand from mostly China and the US in order to really fire up. And that's something which obviously could make it very competitive. The problem that it has is that, you know, in a world which could be slowing down in a synchronized way, you have to sell to somebody, and who are you going to sell to? Particularly high-end machinery goods, for example, which Europe is good at, are going to be difficult. The inflationary impacts, I think, will probably be not as problematic for Europe as they could be elsewhere, just from the perspective that they've been trying to generate inflation for a long, long time and have been unsuccessful in doing that. And it could be the kind of jolt which gets maybe some of the older population to spend a little bit more of their savings. But nonetheless, it could be quite ironic for Europe that just at a time when it looks very competitive from an international standpoint, that the markets into which they sell could be rather weak.
Okay, and I mean, how does the monetary policy backdrop play into all of this, Paul? You've talked there, we were talking about the European economy, and clearly the European and US economies are facing some similar pressures, but also some very different pressures. How would you expect the monetary policy responses to diverge?
Well, I think the US is really determined, the Fed is really determined to keep on track no matter what. And clearly it doesn't have the official mandate of looking to achieve economic growth or to safeguard economic growth, but it is an important aspect of achieving its labour aims. I think that the underlying structure of the US economy is probably more suited to the modern world, a much higher exposure to modern industries. It's been an economy which has allowed creative destruction more than the European economy has, so bad companies or zombie companies don't exist any longer and new ones get created. And that's something which would be, of course, the positive benefit of a more widespread economic cycle or a rate cycle globally. However, in terms of the way that monetary policy plays out to your question, Anna, I think the Europeans will still want to keep inflation to a manageable level. They probably don't mind it being a little bit higher, but they won't be able to go, they won't want to go as far, nor will they be able to go as far as the US will with the Fed.
Hey, Paul, really appreciate your insight today. Thank you so much for joining us. Paul Markham of Newton Investment Management, thank you very much. All right, coming up, the latest YouGov poll now shows Liz Truss ahead of Rishi Sunak after Monday's BBC debate. There's another one tonight. We'll get the latest. This is Bloomberg.
need to get a grip of inflation, and if we don't do that now, it's going to cost all of you and everybody watching at home far more in the long run.
Everybody thinks that putting up taxes at this moment is going to hurt the economy. You can't put up taxes and get growth. If we follow Rishi's plans, we are headed for a recession.
Your own economic advisor has said that that would lead to mortgage rates, interest rates going up to 7%. Can you imagine what that's going to do for everyone here and everyone watching? That's thousands of pounds on their mortgage bill. It's going to tip millions of people into misery.
This Chancellor has raised taxes to the highest rate for 70 years.
Right. The mistake that we will make is at a time when inflation is already high. Everyone's already feeling it in their bills. Interest rates are already on the rise. So into that situation, does anyone think that the sensible thing to do is go on a massive borrowing spree worth tens of billions of pounds and fuel inflation even further?
Okay. That was the tense exchange between the UK Foreign Secretary Liz Truss and the former Chancellor Rishi Sunak at last night's TV debate. Sunak has so far trailed Truss in Tory polling, and of course that is the constituency that they are both trying to appeal to right now. Joining us now for more is Marcus Ashworth, Bloomberg opinion columnist covering European markets. Marcus, very nice to have you with us. So this gets very complicated, and I don't want to oversimplify, but just for the international audience, this is being described as a choice then for those who can vote between more tax and balancing the books on the one hand with the former Chancellor, and tax cuts and going for growth with the Foreign Secretary. That's the way it's described by many commentators.
Or you could put recession with Rishi, or lots of more inflation with Liz Truss. Look, the point here is that I do think that Liz Truss has an excellent argument. She really is the most compelling way of sorting the problems out, but she's probably the wrong person to do it. Ironically, you'd rather have Rishi doing that, and Rishi 3 years ago, before he became Chancellor, would have espoused these exact things.
So balancing the books is not a thing then for the bond markets. For gilt yields, for example, will they not be focused on that in the short or medium term, Marcus?
What I tell you what I'm probably more scared about is Liz Truss's potential park a whole bunch of pandemic debt and somehow extend it, because thankfully she's not expanding on that. I hope she leaves that one be, a bit like she's made clear that the Bank of England will remain independent. So there's a bit of scaremongering around some of her plans, but I think that's because she's not been very coherent around it. However, some of the stuff that Rishi is saying also doesn't make sense.
Marcus, when we talk about, say, Rishi meaning recession, Truss meaning inflation, now it is technical, but isn't there some still headroom left, like 40 billion pounds worth of its next budget? He laughs at me because I'm quoting your own article, Marcus.
I'm not laughing. I'm saying is that there is headroom, but it doesn't mean we won't go into recession. I mean, the point is that, you know, why are we hiking taxes? What Liz Truss is saying is basic common sense. Why are we the only country actually in the world, and I mean OECD, probably in the entire globe, trying to hike taxes at the same time as we've got a cost of living crisis? And you know what? There's a chance of recession. I don't think the UK economy is doing very badly at all. I think it's doing fine. The problem is Europe is about to plunge into potentially a very serious recession, which will drag us down with it. Why on earth would you hike taxes into this?
Yeah, what kind of risks do you think the UK economy faces, Marcus, from what is happening in the Eurozone at this point? Because, I mean, we're reliant on, or we are influenced by gas prices that they pay in Europe, aren't we?
Sure we are. And look, I don't think we're in a great situation in the UK compared to Europe. We have very low unemployment, pardon me. We have inflation pretty much around the same. Look, you could argue it both ways, but Estonia is at 20%. Yes, certain countries in Europe are lower than us, but that's because they're bribing essentially their consumers. So every way around, it doesn't matter. It's all the same. It all works us out in the end. So, you know, as far as the balance sheets are concerned of both the consumer, the household, you know, and particularly the banks, we're in perfectly excellent shape. This is a good place to start a recession from. Will we go into recession? You know, if Europe goes into recession, we'll be dragged down with it. That's nothing we can avoid.
Marcus, thanks very much. Thanks for bringing us your thoughts. Marcus Ashworth of Bloomberg Opinion with his thoughts on the UK economy at this point, as we see those two candidates battling out, of course, to take the top job of the Conservative Party and then become the next Prime Minister here in the UK. Let's take a look at where European markets are trading as as we head towards the close of the European session. The FTSE is pretty flat, but that is a decent performance today, given the challenges being thrown at Europe right now. The Xetra DAX, more indicative of the concerns around higher gas prices. We certainly see higher gas prices today, and the DAX down 0.75%. The CAC 40 under pressure, down 0.4%. We'll get to the close of the European session shortly. This is Bloomberg. Welcome back to Bloomberg Markets, the European close. I'm Anna Edwards, live in London. Guy Johnson is off today. Alex Steele with me, of course, in New York. The European close just 19 seconds away. Let's have a look at where we are and reflect on the session that has been here for European stocks. The FTSE 100 shows grey on the map. It's pretty flat, actually, which isn't a bad performance compared to the rest of Europe, which seems to be pretty firmly in negative territory. As we come to the close of the European equity market session, then this is what we have. Certain markets in Europe very much dragged down by concern about how Europe is going to get enough energy to get through the winter and what Europe can do to try to mitigate the worst of that energy crisis to come. So that's the map for you. Let's dive into the session and see where we've been, the twists and turns that have led us around. And we've been sort of lacking a bit of direction and we managed to eke out gains through some of the European trading day, but none of those gains were very substantial and always vulnerable to negative news flow coming through from Brussels, coming through from Russia, and we got both of those today. So we got certainly the negative news coming through on the Kremlin, which certainly has added to the downside. And in terms of what came through from Brussels, yes, we got a deal on gas, but does it really take us to the end of that narrative? Perhaps not, when you look at the European gas price that we have on the screen there. So the DAX down by 0.8%, as a lot of the pressure is seen falling on that particular economy. And the UBS CEO giving us an interesting perspective, saying it's not just that that individuals will suffer, and of course that matters, but it's also that industries won't be able to work at peak capacity, and that's going to be in itself, he thought, quite inflationary and reduce productivity. And this is the gas price rising yet once again today, taking out the 200 euros measure. We did that earlier on, even if it's dropped back below that now. And the euro suffering as a result, not just against the US dollar, as I have it here, but as Alex was saying earlier, against the Swiss franc and against other currencies. So that's where we are on some key assets. Looking at the sectors, we have seen retail under pressure, and we continue to see that. Still the worst performing sector across European equity markets. Energy is doing pretty well. It was the best performer earlier on. That's that top spot being taken by healthcare, one of the defensive classics, I suppose, on a day like today. And let's get to some individual stock names, because if you've got pricing power, it seems you can still do well in this particular earnings season. We see that well illustrated today. We have Unilever up by 2.8% as a result of, yes, volumes coming down versus expectations at least, or be a little bit less than expectations, but pricing was strong. They were able to pass on those costs, and as a result, 2.8% higher for the Unilever share price. LISM, this is Linton Sprungli. Not enough room for Linton Sprungli, it seems, on our graphics, but you can see that the stock is up by 5.7%. And Alex, people still want chocolate, it seems. Those affordable treats, that's where we are finding money to spend. And one analyst described this as thriving in inflation, which I thought was a nice way of looking at it. For some parts of the economy, that's going to be the case. UBS, we talked to Manus Cranny a lot about this earlier on, Alex. UBS down by 9.4% as various parts of their universe disappointed the markets today.
Yeah, I don't need anything bad to happen to eat chocolate. I can just eat it like all the time. Another big story that we're watching over in Europe, Anna, is travel. London Heathrow Airport says that airlines need to hire more ground staff more aggressively to help overcome those persistent travel disruptions. Now, the cap that it currently has, which is a daily limit of 100,000 departing passengers, could now be extended. It was supposed to end in the fall. In an interview with Bloomberg, CEO John Holland Kay said that this is not going to be a quick fix. It's absolutely possible that we would have another summer with the cap still in place. It's going to take another 12 to 18 months, and not just at Heathrow. Joining us now for more is Siddharth Phillip, our European Airlines reporter. Sid, I feel like this is just unprecedented. And at the same time, Heathrow is really starting to throw a lot of shade at airlines, saying, we're doing our job, guys, you are not. What's the feud?
Yeah, so, I mean, everyone's sort of blaming the other for not really getting the act together as travel came back. And now Heathrow is sitting out at the airline saying that they need to hire ground staff more aggressively to sort of overcome the issues that are facing. And the airlines themselves are saying that it's Heathrow is imposing limits and they have enough staff. So it's really a question of blame game all around. Everyone's blaming the other for not being able to ramp up and also having to cap capacity.
So this comes down to whose responsibility it is then, Sid, to find the staff that help you with check-in. I mean, I didn't think there were any staff helping with check-in these days. I thought that was all down to you. I thought you were kind of on your own when it came to check-in. So it's nice to know that there are some staff for some airlines. But baggage handlers and air bridge operators, those big contraptions that they drive up to bump up to the door to allow you to disembark from the plane. This all comes down to whose responsibility is to hire in those staff, to hire those people, but also what defines enough. I mean, is that what this is coming down to?
Absolutely. So it's all about who does what. And while the baggage contractors and everything are hired by the airlines to manage their bags, most airlines don't handle bags themselves. They get other companies to do it. They outsource it. At the other time, they also have security queues and mountains sort of within the airport and sort of lines snaking through the terminal. That's the airport's responsibility. So it is a sort of question of different functions have different responsibilities. And the fact remains is that there is insufficient staffing across the airline industry. And that's really affecting everybody regardless of who blames who. I mean, we had the EasyJet CEO talking earlier this morning, and he said that nobody is really not feeling the pressure or the squeeze, and it's everybody across the sector.
Yeah, and safe to say I'm not going to London now anytime soon. The other part of this is what's happening with current workers too. So I'm just looking at Lufthansa, for example. There's a ground crew strike that's had to close some of its major hubs in Frankfurt and Munich today. Talk to us about why it's so hard for airlines to just hire and pay workers well. Like, what's the holdup in getting all that done?
So it's a really a twofold problem. One is the fact that, the airlines sort of cut staffing through the pandemic. The second is a rising cost of living, and that sort of had a massive knock-on inflation and in turn workers asking for more. It's also a question of workers understanding that airlines are staff-strapped at the moment, and so they're in a very good position at the moment.
Sid, thanks so much for joining us. Really good to speak to you. Bloomberg Siddharth Phillip with the latest on the aviation sector, both in the UK and in Germany. Quick check on the markets then as we work our way through the settlement process here in Europe. It has been a pretty down day for European stocks. I know that's being echoed certainly in US equity markets. There's a lot going on, factoring in the earnings stories, but also gas expectations and fuel expectations into the winter. The FTSE 100 is flat. The DAX down 0.9%. The CAC 40 down by 0.4% then, Alex.
All right, we're going to follow all these stories for you on Bloomberg Radio's The Cable Show that comes up at 5 p.m. in London, 12 p.m. in New York. It's live on Bloomberg DAB Digital Radio. Also check it out on Spotify and Apple for podcasts. I will be with you to take you through all of these top stories, particularly commodities. So the EU is preparing for a winter nightmare. You got members voluntarily cutting gas usage over the next month. There is an agreement, but let's dig into some of the details as power prices and energy prices are still at record highs. This is Bloomberg.
Great questions.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. Russia will opt out of the International Space Station after 2024 and focus on building its own orbiting outpost, according to the country's new space chief. The move comes amid tensions between Russia and the West over the war in Ukraine. Yuri Borisov says Russia will fulfill its obligations to other partners at the space station before it leaves the project. In France, concern is growing over the rising cost of the Paris 2024 Summer Olympic Games. The total price tag has jumped from about $7 billion in 2018 to $8.5 billion today. But the final cost is likely to be higher because France is increasing security and will pay more for construction and materials. Now the European Union is preparing for the possibility of a full cutoff of Russian energy supplies. EU nations agreed today to cut their natural gas use by 15% through next winter. The rapid pace of agreement reflects the rapidly deteriorating gas flows from Russia.
Today the European Union confirmed its unity, solidarity and preparedness as one of the ministers says, the manifest of unity and solidarity. We have made a huge step towards securing gas supplies for our citizens and economies for the upcoming winter. The negotiations were not easy, and I would like to thank all my ministerial colleagues and their teams who were working tirelessly around the clock to prove that agreeing today is not a mission impossible.
Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex.
All right, Angel, thanks so much. Let's talk more about the gas story now and bring in Bloomberg's Lyubov Pernina in Brussels. In terms of the agreement to reduce 15% of gas consumption, is it mandatory? Do any countries have an out?
Indeed, today, European Union energy ministers agreed to support a proposal to reduce gas demand by 15% going into the next winter. So far, it's voluntary, although it starts from today and any country can participate. But there is also a trigger mechanism which makes it mandatory if there is a complete halt of gas supplies from Russia, or, for example, if 5 out of 27 member states ring the alarm bell and alert the countries that they're in a critical situation. There are also some exemptions. Some are automatic and some are not, which actually help to bring most member states on board today.
Lyubov, so progress, but there are still some hurdles perhaps, or some realities still to be faced up to, if indeed we do see these worst case scenarios, which we haven't yet. We heard from various EU voices that they were planning for enough gas for an average winter. Is that still a risk then, that things might not turn out to be average?
Well, it's difficult to predict, but indeed European Commission officials and also energy ministers today have been saying that there could be enough provisions for an average winter. But even so, in a more cold situation, European Union managed to secure sufficient and additional supplies that used to come from Russia but have been now covered by other supplies from third countries, both pipeline and LNG.
What happens to countries that have their storage full? And I'm thinking about Poland. Is there discretion in terms of then what sectors or what industries will have to be hit?
Many member states during the debate asked for a certain flexibility, that different issues, geographies, and including particular storage capacities and levels are taken into account. And this is something that is also being taken into account by the Commission following today's ministerial meeting in Brussels.
Okay, thanks so much, Lyubov. Good to speak to you again. Lyubov Pronina with the latest on the news flow from Brussels on the subject of gas. Joining us now with further analysis, Katerina Filipenko, Wood Mackenzie Global Gas Supply Principal Analyst. Very nice to have you with us, Katerina. So talk me through how significant this deal is then. We were just hearing some of the details being set out to us by our colleague. There are triggers in place to make it mandatory, but at the moment it isn't. And there are exemptions, and so not everybody is going to be taking part just now, but how significant is this deal?
Right, so we believe that this is definitely a step in the right direction. It is definitely a very important and necessary step, but it's all down to implementation, right? And we believe that Europe has to start cutting gas usage as soon as possible. So yes, it is voluntary, but Europe needs to make sure that it's prepared for winter. So the member states need to start cutting gas already soon. But even then, it may not be enough.
In the meantime, what's your base case for what kind of gas comes out of Russia? We already are seeing 20% reduction for Gazprom. Uniper says they're just receiving 33% of Russian gas versus 40% on Monday. But Russia needs to keep something flowing to keep the leverage. If they go to zero, there is no leverage.
Yeah, absolutely. So we believe that Russia is incentivized to continue flowing some gas in Europe. On one hand, it allows them to maintain high revenues, and gas is one of the sources of hard currency for Russia. And at the same time, it allows Gazprom to disincentivize European cutting of gas usage already now, which is so much needed. So basically, it makes Europe even more vulnerable for when flows can potentially be cut in winter, for example. So we believe that Europe will try to, Gazprom will try to flow some small volumes, but disruptions will continue.
Okay, disruptions to continue, Katerina, you think. So in that regard, what do you follow when it comes to the Kremlin giving us details of various turbines and where they are, and only 6 of the turbines in operation at this point, and things need maintenance? I mean, do you follow this and think it's material, or is it just all about political judgment coming from Moscow?
So we follow the turbine developments, but we do not believe that turbine is a guarantee of stable flow, by no means. We see that Gazprom all the time had an option to send more gas via Ukraine, but they choose not to do it. So we don't believe that turbine is the key to stable flows from Russia. So it's more a political decision.
Katerina, another big part of this story that I feel like has been sidelined a bit is China. So China's been ramping up their coal production, and that leaves more LNG to go to Europe. Is there any indications that China will be restocking their LNG levels, in which case it's going to make even tighter supply and tighter markets for Europe?
Well, Chinese gas and LNG demand is down this year, significantly down this year. So we believe that this somehow helps loosen the market in general. But definitely there is a risk of upcoming winter, and especially if there's some relaxation of COVID restrictions. And if there's a very cold winter, for example, in Asia, we can see some LNG being diverted away from Asia, from Europe into Asia.
Katerina, do you think this political deal that's been reached in Brussels today, do you think it will hold, given that we've got a voluntary agreement in place right now, but when it starts to become mandatory, is that going to test unity on this subject?
It can potentially test the unity, and we will see over the coming weeks and months how eager the countries are to implement. We already see that some countries, like southern countries, for example, are not too keen to implement this, but we believe that when the alarm bell is rung, then probably Europe will step up and they will have to implement the cuts.
I feel like everything tests the unity of Europe now, I have to be honest. It's how it looks like from the U.S. side. Katerina, I'm curious, when do you wind up seeing the top in gas prices? And this is a totally unfair question. How much more upside is there to gas prices and power prices? Like, what's your upside forecast?
Yeah, well, sky's the limit, basically.
Yeah.
But we already see that market is very nervous, and I believe that market to some extent is factoring in the risk of further disruptions, but it's really impossible to say what will happen this winter, particularly if we have extremely cold winter and the peak gas demand in winter, then prices can potentially shoot up. But to some extent, the market is already pricing in some risk of disruptions.
Yeah, but they're still surprised when they come. It's very fascinating. All right, Katerina, thanks very much. Katerina Filipenko, Woodmac Global Gas Supply Principal Analyst. And we're talking about the consumer being in a recession, not if you're LVMH. We just get numbers crossing right now. Really, really good numbers. You're taking a look at overall, say, fashion and leather goods, and that's the barometer you want to be watching for LVMH. Organic sales there up 19%. That just crushes estimates. Wine and spirits, their organic sales up 30%. I mean, these are really big numbers that they're throwing out. They're going to pay an interim dividend of €5 per share. Overall, organic revenue up 19%, and total they're looking at 18.73 billion euros of revenue. These are seriously large numbers.
Yeah, absolutely, especially when you consider that a big portion of this business is still in